And let's talk more about the markets from the fixed income side of things. Let's get back to Yahoo Finance's executive editor, Brian Sozzi, with exclusive coverage of DoubleLine Capital's Investor Day. Soz?
Hey, thanks, Julie. Joining me now is Monica Erickson, DoubleLine investment grade corporate credit manager. Monica, good to see you as always. Thanks for spending some time with us. Top of mind, I imagine with you and your team right now, is interest rate risk, how far rates might go. What is that doing to how you think about your products and what you run?
Yeah, well, I mean, that's where the volatility has been. The volatility has not been in spread product. It's been in the treasury market. That is what contributed to about 90% of the negative returns last year, which was, as you all know, one of the worst years in over 100 years for the investment grade market. And I would anticipate that the volatility is going to continue to be in the treasury market, and less so in terms of where credit spreads are going. And you and I talked about this last year in January, and
a year ago.
I know, I can't crazy, believe it. Right? And so what we were talking about then was just the duration of the asset class. The duration of the asset class then was at all-time highs, and we were very concerned about, and duration really is the sensitivity to movement in interest rates, and we were very concerned about the asset class then because of its long duration. Going into this year, it's a little bit better set up. Yields across the board, all fixed income are much higher. You're getting close to a 6% yield in the investment grade market, which is at decade highs. And the duration has come down. So the setup is better, but I'm still watching the volatility in the treasury market.
Given all the concern about where rates are and where they might head, have you been surprised by the flows into corporate bonds?
Not necessarily. I think flows tend to follow returns, and we started this year in January with pretty strong returns. The market was up about 4%. The last couple of weeks have been a little bit more challenging just because of the move in the treasury market. But no, I think that's just a natural progression of kind of what happens when you see positive returns in an asset class.
I talked to Jeffrey Sherman, Deputy CIO, earlier on. He was talking about the potential for a mild recession. If that does come to fruition, whether it's later this year, early in 2024, how does it impact what you cover?
Well, one of the things, there's several things that we look at, right? And fundamentals really, and that I think that goes to that point of like where are the fundamentals going? The fundamentals, and this is something we talked about last year as well, are fairly strong in the investment grade market. You look at kind of where leverage is. Leverage has come down from the peak. We're at like, call it 3 times kind of cash flow to debt. Interest coverage is pretty high. We're close to all-time highs where companies have about 15 times the amount of cash flow each year to cover their interest expense. And so watching earnings, I think, and that flows back into kind of where the economy is going, is really critical to see where those metrics might fall out. And for the fourth quarter, which we're almost done with earnings, really
good.
Yeah,
good, Monica.
Right.
Earnings season, these seasons just they keep going. They don't end.
Right. Well, and it was an interesting quarter because the weakness was really in the large banks and in tech and large tech like Apple, Meta, those types of companies. So it was really much more of an equity story and less so of a credit story because the banks' balance sheets super solid. The tech companies, the large tech companies, have more cash on their balance sheet than they do have debt. They generate enough cash flow to pay off all of their debt. They've just raised debt over the last 10 years because it's been opportunistic and cheap financing. So this weakness in earnings in the fourth quarter really is much more of an equity story, less of a credit story. Now, going forward, we're definitely watching to see what areas, what sectors are going to be weak in this year, in 2023. And so far, kind of if you look at consensus estimates, it's really in the energy sector and in materials. Energy is coming off an incredibly strong year last year. And it tends to be a pretty small part of the investment grade market. So the bottom line is, I think the energy or the earnings picture looks pretty benign for investment grade credit just because energy is such a small part of the market. And it's really related to tough comps. Balance sheets are still strong.
Let's lock in on the tech sector. Investors awoke today to an icon of America, Intel, cutting its dividend.
Right.
A lot of investors, I'm sure, can't even believe this is happening. But as you zoom out into the broader tech sector, are there more Intels around? How confident are you in these tech fundamentals?
Yeah, well, Intel is an interesting story because they have very specific issues going on with their business. They've been losing market share to their competitors. And I think cutting their dividend is an indication, and I think it's kind of across the board where companies really are focused on their balance sheets, right? So Intel is one of those companies where, and we've been looking at it, right? I think that their fundamentals, they've had a difficult time kind of turning that around, but they are focused on their balance sheet and making sure that it's solid enough that they can come to market when they need to raise capital. And like I said, with the other tech companies that had really bad earnings in the fourth quarter, these are companies like Apple that have more cash than they have debt on their balance sheet. And so it's really, that part of it is much more of an equity story.
So is that where you're finding opportunity? Just stay in cash-rich companies with good fundamentals. Maybe it is an Apple.
Yeah, absolutely. It's kind of going up quality across the board, right? And I think that is what we're doing here at DoubleLine, is that we're really looking for credits, companies that can withstand some volatility in the economy. I mean, I think there's a much higher probability that we go into a slower period, if not a recession. I mean, so far it looks kind of balanced, but I think at some point we will get there. And so I think it is the right time to go up in quality and find companies that have solid businesses, solid fundamentals that can withstand some weakness on the macro level and that have the balance sheets to withstand it as well.
We're starting to see a lot of interest on the Yahoo Finance platform, Monica, on the debt ceiling, how that might impact stocks, how that might impact bonds. As that event approaches, do you see that as destabilizing to the bond market?
Not necessarily for our market. I think that is probably a short-term situation, and I think eventually it does get worked out. I think the biggest risk in our market remains the volatility in yields in the Treasury market. And I think that's going to be driven much more by inflation, the ability of the Fed to control inflation, and where the Fed goes with their interest rates.
So the Fed, the biggest risk to markets this year?
That's my opinion. I think it's, so the balance of if they can get inflation under control, I think the market will back off in terms of volatility in the Treasury market. If they can't, that's going to be a continuing issue that we're going to have to face.
All right, we'll leave it there. Monica Erickson, DoubleLine Investment Grade Corporate Credit Manager. Hopefully we can speak before 2024.
That'd be great. I'd love it.
I appreciate it, Monica. Thanks so much. Julie,
Thanks,
back to you.
Brian.
You got a lot of time before 2024 to speak with Monica.
A lot of time.
Thankfully. Soz, we'll talk to you in a little bit, much sooner than that.